R. Sivakumar, Head Fixed Income at Axis Mutual Fund. Thanks very much for joining us, Siv. It's great to have you on the show. Do you think that the RBI remained unjustified in remaining to be hawkish in this meet, as some strategists are saying they did? They could have at least indicated that they are flexible to move their stance.
They are flexible to move their stance. I think they've said that if, to be quite exact, if the upside risks to inflation don't materialize, they will relook at the stance. But RBI, I think, found itself in a very tight spot because they just moved to the tightening stance in the last policy, and to switch so soon would have been a very they would have been taken to task for being flip-flopping in terms of policy stance. So I think they have softened in their mind. But it's probably going to take a few more policy statements before they can genuinely make any changes to the rates itself.
Right. So when is it that you really see a calibrated tightening stance get reversed, Sivakumar? And what is it that you made of the other two changes which were announced, the cut in SLR gradually by 25 bips a quarter starting from March 19 to 18%, from 19.5% currently? Do you see this as a positive from banks? And also the benchmarking retail floating loans, do you really think this will improve things in the system?
Yeah, so clearly the reduction in SLR is in a way freeing up some government securities which the banks can then repo back to the RBI or surrender or give it up in OMOs, basically to sell it back to the RBI to raise liquidity. So that's a positive step. And in a sense, what the RBI is saying is that as the LCR norms kick in, we will have to offset that liquidity demand for LCR through a reduction in SLR. I think this is sort of pre-programmed in some sense. So this will increase lendable resources within the banking system. So that's a fair positive. On the other item, on the benchmarking of loans to market interest rates, I think it's an interesting step. It will take a while before we figure out how this impacts the industry. There are two things I can see coming into play. One is various banks may choose different benchmark interest rates to price different loans, and banks and NBFCs are not both governed by the same rules. So banks will have external benchmarks, but NBFCs will continue to price loans differently. So this is going to be interesting to see over the next 6 months as this guideline kicks in. To see how this transpires. So I don't want to prejudge that. It's going to be interesting is all I can say.
Right. What's your own view on the bond markets and what they're signaling? G-Secs have fallen about 50 basis points in the last few weeks. Where do you see the range from here on? We're also, by the way, seeing that play out with US bonds as well as Italian bonds, so largely it seems like there's some sort of risk aversion which is finding comfort in investors moving towards buying bonds.
Yes, but normally that does not play as much in emerging markets. So for you don't see emerging market government securities as a sort of risk off gainers, right? So the EM debt is also seen as a risky asset normally. But here in India we have a very specific, I think, a different set of circumstances. Just because of this anticipated switch in RBI stance, I think we have seen a sharp fall. Normally in a sort of steady state environment, I would expect that the 10-year G-Sec should trade maybe 75 to 100 basis points over the repo rate. Repo rate is at 6.5%. Consequently, we should see the 10-year maybe at about 7.25 to 7.5, and that's 7.40 is where it is right now. So what the market has done essentially is moved from a couple of rate hike expectations into a no rate hike and maybe a chance of even a sort of change in stance over the next 1 or 2 policy statements. So effectively the market has moved into a zero stance, that is to say a neutral stance mode. We will have to now wait and see over the next few months what the trajectory of inflation is. Clearly over the next couple of months at least, inflation will remain very much below even the RBI's 4%. It will probably be below the 3% mark, and that should give a lot of support to markets. But on the flip side, we have seen the data, for example, on the fiscal deficit, which has certainly come on the higher side till October. The GST collections continue to underperform what is the required run rate in some sense, and therefore I think market will have to be a little bit cautious before yields drop much further from these levels.
Okay. Sivakumar, thanks very much for joining us and sharing with us your views on the RBI credit policy. Appreciate your time and insights.